In Hawaii, there's so much to do. There's hula, there's surfing, and real estate too. We just two local guys with so much to say. So listen to the Real Estate Brothers today.
All right, here we are. This is the Real Estate Braddahs. We just got that new theme song that Dean or someone really famous sang for us. Yeah, so legal disclaimer and notice here. This is just for your information, and please consult your professional for any investment or legal or tax advice. But here's Dean, my partner in crime. If you guys want to contact him, there's his information. But yeah, what are we talking about this month?
Oahu statistics. Again, we're talking about January, the 2019. February will be coming up in the next few days, so maybe we'll work on the timing of this so that we have a little fresher data. But as of right now, this is as of January 2019. As you can see, we have some consistency in terms of median single family prices and condo prices, as well as across the board in terms of closed sales in these markets. So single family prices you see for January 19, we have 767,500, um, and then that's a 1% decrease from prior year, as well as median condo prices just under 400,000, a 7% reduction from prior year. Closed sales we see decrease on both sides, single family and median condo prices at 2% and 13% respectively. And days on market, we see an increase on both sides for single family and condo prices, both at 27 days, and pretty big increases from prior year. So basically, it's that's very good signs, consistent signs for the buyer, and keeping in mind that this is for Oahu in total. So one thing I want to bring up too is when we're looking at single family prices, we see the decreases at the 1% and 7%, and it's great for the buyers. But if you look in their next slide, and I had showed this one, this same one last month too, where although we're seeing the, the slight the arrows going down, if we look at this trend and just graph it out, it's still pretty stable. I mean, we're seeing it slightly dip on the single family, starting to curve down in the last 4 months, but still in that same ball.
So what are you seeing in your last listings? Are they going for more than what you're listing, or are you
Yeah.
kind of
So
listing it?
again, it's all about pricing too. But my point is that you know 2 years ago I was seeing multiple offers. I was in one situation where we had like, this is for single family in Newtown, where we had six offers, two at asking, four at over. So talk about the seller having a lot of leverage in terms of picking and choosing and countering. But in this current state right now, including taking into account seasonality, it's not as appealing for the seller. Don't get me wrong, it's still a seller's market. It's just that I think the buyer is getting a little bit more leverage, and it's a little bit swinging in their favor. Not so much, it's not like the buyer can pick and choose and just wait around or anything, but um, I guess going back to a few years ago, we'd have multiple multiple offer situation where the highest offer was like way above the list price, and the buyer's agent would be calling and saying, "Hey, Dean, my buyer, he's put in five offers this year, and none of them were taken, and he hasn't even wasn't even considered for backup. So in this sixth offer, we're putting in X amount over asking, and have a strong buyer pre-approved and ready to go." And sure enough, it was a very very strong buyers, and it's at that time, them going through that process and going through the education, they were now strong buyers, and in that time frame, that's what it took, right? Six offers to finally be ready to win. So times have changed now, and now, like I said, there's it's more swinging towards the buyers. Still a seller's market, but buyers have a better chance, I think, statistically in this current.
But still, people are, like you said, people are like waiving the inspection all the time. That's pretty typical.
No, no, I'm not. Personally, I haven't seen waiving of inspection, not at all, because I mean that's something that protecting the buyer, and that's yeah. I mean that's not like on the mainland, right? How we've been seeing. I don't see that, or like on wholesale prices, wholesale deals. I haven't seen any that kind of thing. I would say extreme. I haven't seen anything that extreme. I would say because, like I said, it's still seller's market now. So, all right, sorry. Back one, Marlene. I had a question come to me the other day from a friend and was asking me about that how she's seeing a lot of inventory pop up in her neighborhood, which is Kailua. So I was telling her, and said, yeah, that is true. Things are going, inventory is picking up, but it, real estate, as we mentioned multiple times, real estate is local. So prime example, and I thank her, Shelby. I'll send this link to this podcast so you can hear. But thank you for that question because the prime example is we look at Kailua, Waimanalo area, and to her point, inventory has been going up. We've been seeing price reductions, but if you look at the median single family price, 982, it still went up from prior year 13%. So although we're seeing inventory going up, we still haven't seen prices, especially in those areas, Kailua and Nu'uanu, any comparable decrease or consistent with the inventory increase. And I think that has a lot to say about our just overall lack of inventory, and the demand, the pent up demand is still there. So that's still having the prices go up. But I mean, who knows? There hopefully will be a point of time or equilibrium where then you'll see the median prices drop along with the inventory increases. Yeah. But interest rates are still relatively low, so we saw that decrease in December, in which was inconsistent with the Fed rate raise, right? So um, that coupled with the fact that we have just a shortage of inventory here on Oahu, so I think that'll help us maintain the prices, especially if there's like a correction, macroeconomically in on other parts of the states or parts of the world. Um, I wanted that brought me to more news. And this one's not really related to residential, but is actually commercial based. But it had a good lesson at the end of the article. Basically, what happened was in 2018 we saw a bump up in commercial transactions. So 515 billion in 2018 versus 3 billion in 2017, which is a really big 67% increase. And the predictions at the time in early 18 was actually for a reduction from from prior year from 17, but it actually went the other way. So and in 2019 they're also expecting or kind of predicting reduction to, they're saying, Colliers, who issued that report, said they're thinking it could go down to 4 billion for us. And I think that goes to the point of the last quote of this article, which is in the Star Advertiser, was, you see highlighted in yellow lane. Investors will scour our market for opportunities, and those that adopt creative strategies can be successful in this increasingly challenging market. So I think that goes um, to me, he talks about, a lot of people are waiting for that correction, and they've been waiting for, some have been waiting for 3 years when they're saying the stock market this this bull market can't go on, and so they went into cash. But um, if you invest wisely and you look for the deals are out there, and you can.
Yeah. And who cares if you're buying the best deals? I mean, you're kind of just dollar cost averaging, but with hard assets too.
Yeah, yeah, exactly. So I mean, that's what my point of that article was.
All right. So if you guys like more like mainland investing stuff, check out my podcast, simplepassivecashflow.com, blog Simple Passive Cash Flow. And also come and check out me and Dean at the REI Aloha meetup we do. It's free. It's a good price there. And yeah, come out. We had a meeting the other week at Pi. And if you guys want a copy of my book, text ebook to 5873176099. So this week I took this doing all the mainland stuff here, which is more like macroeconomics. Sales volume is kind of on record once again to reach a high level. Cap rates, which is the rate that you're making gains overall on a non leveraged property, are getting lower and lower. People are having harder and harder time to find yield. Rent growth is getting a little slower, and you guys can kind of pause the video if you want and kind of read through these. And I also picked up a few articles here that I thought were interesting that you can pause the video here too and read on your own time, or subscribe to our newsletter by the bottom of the screen. Text Aloha to 314-665-1767 and get all these emailed out to you, along with all our meeting times and all that. So kind of the title of this slide here is, Hawaii has a lot of equity in our houses, and you would think that's a good thing, but in my opinion, Hawaii people have too much lazy equity. Imagine if you use some of that equity to just go buy a turnkey rental on the mainland. I always tell people this, like, for every $25,000, you could go buy a cash flowing property that will make you $200 to $300 a month. It sounds crazy that there's $100,000 houses out there, but that's how most people live in America, and they're solid renters. And $25,000, that should get you their 20% down payment and some closing costs to close on that. So Hawaii is very very unique with how much equity you have. Um, I kind of see it as more, I don't know if it's an Asian thing or what, but it is a very fiscally conservative way of doing it, which is not always the best way if you're trying to grow wealth.
Yeah, and Blaine, not to mention that 200 to 300 cash on cash return is excluding the potential tax benefits as well as your equity paid on. I'm thinking, right? So there's a lot of other benefits besides that cash flow coming in.
Right, right. And in addition, I know you and I don't really invest for appreciation or more on cash flow, but if the property does go up by 5% and your leverage 4 to 1, now you just made 20% on your money. So also the appreciation too. Right. So I gave a talk at the conventions that are this past month, and a lot of the talk in the room was, hey, Hawaii is a primary market here in the left, along with Los Angeles, San Francisco, Miami, Boston, DC. These are the places that people normally think to invest because it's kind of top of mind, cool places to live, which they are, but the numbers don't work here. And cash flow investors look at the rent to value ratio. You can take the monthly rent divided by the purchase price of the property to get the rent to value ratio. So in Hawaii here, I mean, I live in a house that's about $1 million, and I rent it for 3,000. So that's a 0.3% rent to value ratio. Where a lot of these other places in Birmingham, Atlanta, Indianapolis, Kansas City, secondary markets, you're able to find properties that will have the 1% rent to value ratio. So it'll be $100,000 house that rents for $1,000. And then, because the secondary markets are getting even hotter these days, people are having to go to tertiary markets, Huntsville, Pasco, Washington, Waco, Texas, places you probably never heard of before. But hey, this is where you have to go to for yield these days. Um, right, and these places on the right, I call them question marks. Tacoma, Washington, next to Seattle, I consider that Seattle. Kapolei, Hawaii. That's you're thinking you're trying to go off the beaten path. No, you're still next to Honolulu. You're still not getting rent to value ratios that work. I think you're also seeing that with Las Vegas and Phoenix. You just have so much unsophisticated money going from California out to those markets. Dean, you're in what, Kansas City and Vegas here?
Yep, I'm in Kansas City. I'm in Vegas. I'm actually in Kapolei too, but
So
that was for different reasons. That was to kind of balance the portfolio, and it wasn't a cash flow play. It was more of a like again to balance the portfolio. I did 1031 to bring a property from Las Vegas where I thought that the prices have petered out, and I wanted a little bit more control, so I brought it via 1031 to Kapolei about 3 or 4 years ago. So that one is more to balance the portfolio, have something here on Oahu, and that is
yeah, so like your Kansas City stuff, what did you buy? If you were to buy it today, how much would it be, and how much would it rent for? Just to calculate the rent to value for the folks.
see. There's like anywhere, Kansas City is a big area, and there's various micro markets within. So I know that there's some turnkey providers that are um, following this 1% rule. The stuff I'm picking up is I like to think of as a little bit higher end neighborhood, not in the that C plus B minus stuff, but a little bit higher. I'm doing also like duplexes, single family, and in a little bit better school districts. Yeah, pretty good school districts. So my latest acquisition, I think, was 250K for a duplex that was getting a little maybe 2100, but under rented. Like the market should probably be more towards the 23, 24. So just under the 1% rent to value ratio.
So by the time we release this video, you and I will probably be partners on this El Paso deal. Yeah, that sucker is 47,000 a unit, and the average rents today are like 600, 650. So then hopefully we can bump the rents up to 750 or more. So now you're talking almost 1.5, 2%, that kind of area. So here's some other markets. Something to think about. You always want to go into markets where the economy is diversified. So good examples of that not being is like Detroit, right? It's a lot of just automobiles and whatnot. The green ones are kind of the better ones to be in. I like I like Oklahoma. I like the Southeast actually. Just a lot of manufacturing and blue collar jobs. Where Seattle, Seattle's just more tech. Los Angeles or Las Vegas, there's obviously just more tourism industry. Yeah, yeah, a lot of tech, like tech is kind of going in there too. Another thing to avoid is these gateway cities, Hawaii being one of them, where you just have a lot of people from the outside, out of the country, just wanting to launder money here, in my opinion. So this is just another reason why to stay away from these are mostly the primary markets. Just an interesting chart on where the whole home ownership rate is going in America. Kind of saw a little dip there, or a mini bottom at 2016 for some reason. And the home ownership has been kind of coming up. I don't know what that is all about. Maybe the baby boomers are just finally having kids these days.
Maybe after the subprime.
Yeah. All that pent up demand has to bounce back at some point. But everyone's got to know that, back in 2004, I mean, and 2006, that was artificially, George Bush's agenda, whether it's him or not, right? It's the the tax kind of incentivizes different things, and they were heavily incentivizing people to buy houses. Where now, I mean, you don't even get a tax deduction for your interest you pay on your primary residence if it's over a certain amount. So that's kind of, you follow the tax, you follow where the money goes, you follow what people do. People are moving in with mom and dad more. These two charts kind of show that. It's kind of a no-brainer, I guess. But something I've been kind of working on, Dean, that I work with a lot of people that are $1 million to $2 million net worth. I call them first generation worth wealth people, and this is who I kind of like to work with. I wasn't really born with too much money. I wasn't poor, but I by no means was going 40 miles an hour and went up to 120 miles an hour. I kind of had to go from 10 to 55 if you're thinking in terms of driving down the highway. So it's been kind of a passion of mine, but here are some things if you guys want to take a look and read later. Things I have learned from kind of rubbing shoulders with the wealthy on things they do. Just the way they invest, and they think about taxes. Think taxes like a big thing. I mean, I made just over under 100 grand last year my W-2 job, but I mean I only paid 14 grand on taxes. Yeah, less than my school teacher girlfriend. So it's telling you something there. Um,
Number two, that just looking at this, number two, very applicable to Hawaii
right, right. Just the keeping up with the Joneses, right?
people, right? And you're maxing out. A lot of times you're maxing out your buying potential. Getting a balloon loan to buy something that's not even your dream home. You're settling for like a fixer upper and it's just based on the high cost of living and the high prices in Hawaii. And
Right, right. And I think you and I both went to private school, and we kind of saw a lot of kids who their families had a lot of money, but the you just kind of bunch of decaying wealth, right? They're just kind of holding on to what they have, not growing it, and that kind of speaks to point four here, lack of integration, and you know number five, diversification is kind of that line of bull that every personal financial guy says, you got to diversify. Well, that's just so that you can't really point it to them, right? I mean, that's like at work, right? You try and if you don't do too much and you kind of stay quiet and diversify, you keep your job, right? It's the it's the risk takers or the people who kind of stick out who get hammered. But I think when it's wealth building, you've got to kind of get good at something. And Andrew Carnegie says, put all your eggs in one basket and watch that basket like a hawk. And that's what high net worth families do. They know what kind of game they're playing, and they find things that play to their strengths.
stick to what's in your wheelhouse,
Right. And they buy ancillary businesses that kind of use their infrastructure, personal networks, and unique trade knowledge that they acquire throughout the years. Different key indicators that I look at here on the left, you have the unemployment rate. I don't think that things are going to get much better economy wise than now. I mean, the whole ghosting term these days is not just in Tinder. It's, there's people have so many work opportunities that people aren't even going to interviews or giving the employers a courtesy that they're not coming anymore. Or they get the job, they don't even show up. I don't know if it really happens in Hawaii, but it's definitely happening a lot on the mainland because any kind of things happen on the mainland, I guess. But I watch it that I think 3%. That's the historical low that you really can't go below that. So, my opinion, there's going to be a recession in the next 1 to 3 years, and it's just going to be something like a black swan event. And what a black swan event is, something that triggers people to get a little scared, and that's sort of thing that triggers the sell-off. Here are some ideas of what that could be. But at the end of the day, I think you and I kind of see the market the same way, right? Like we said, you got to keep buying assets that make you money, and investors, try all these different asset classes, and some track up, some track down. But here's what I look at personally. I look at, what are people buying? What do people make? What's the spread between what they're making and what they're paying in their interest rate? That's really how you make money as an investor. It's basically an arbitrage between the rate. So as long as there's a gap, you're fine. So I think it's kind of a fallacy to kind of, brokers are kind of guilty of this all the time, right? And you see this, Dean, with your guys, right? Like you're saying, oh, the interest rates are kind of at all-time lows, right? People freak out when it goes up a little bit, but who cares if that asset is going to make you money and kind of track up with it, which it typically does. And that's what this chart is showing, that spread between the two. But yeah, I mean, a lot of good conversations over good times and good people. We had our last happy hour at Pi, and we'll probably have another one this next month. Check out reialoha.com. And more from the Real Estate Brothers. Please submit your questions, and we also have probably a breakfast club meeting one of these days. So that's like a Saturday breakfast for investors who are interested in investing on the mainland. Come out. But yeah, thanks for joining. Anything you want to leave off there, Dean?
No, not. I think covered a lot this session. So yeah, I would like to see more people come out to the event. So you've been having really good turnouts, though. I'm say, Lane. So and I have to make it out to the breakfast one. I'm looking forward to that one. I love breakfast.
Yeah, good price. It's Zippy's.
But yeah, like you said, it's fun because all the like-minded people, and it's networking is so important.
All right, man. We'll catch you guys next month. Bye.
Hey, just some legal stuff here. Although these two brothers are pretty knowledgeable and have over 2,100 rental units and own over $160 million worth of real estate, the preceding are only ideas and not to be taken as legal, tax, or financial advice, okay? You should always seek the professional advice of other professionals on your team and think for yourself and do your own due diligence, okay? Aloha.
We're just two local guys with so much to say. So listen to the Real Estate Brothers today.